Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So U.S. equity markets are very strong. U.S. large cap growth continues to lead the way in 2024. Also, CPI lingering at 3.4% year over year. Shelter, right? Rent cost remains the strongest driver of inflation in April. And finally, credit card debt is high, but when you compare it to US personal income, it's actually below pre-COVID levels. Now, first, markets are up strong. The S&P 500 there in the orange is up 12.2% through May 21st year to date. Also on the screen, we have the Russell 2000 small cap index, the S&P 400 mid cap index, and those Russell value and growth index. Couple notes: US large cap continues to outpace small cap equities, and large cap growth up 14.2%, drastically outperforming 8.7%. That was the theme, if you remember, of 2023. Large cap growth, large cap tech, outperforming small and mid cap stocks, especially on the value side. You can see small cap equities only up 4% year to date versus their large cap counterparts. But inflation, right? Nobody expects the Fed to cut rates until at least September. We're looking at probably 2 rate cuts this year. But let's take a look at that CPI report that came out in April. It was up 3.3% year over year versus 3.4% the previous month. If you look at these components here, we have food, energy, core goods, shelter, transportation services, and other services. Those three last parts, shelter, transportation services, and other services, that is all combined into that services component. But if you break it down a little bit and look at it, that shelter component, right? That's the cost of rents. That's the owner's equivalent rental cost of housing. That is a 35% weight in CPI and currently at 1.9% year over year inflation rate. And transportation services, primarily driven by auto insurance, is at 0.67%. If you combine those two only together as a percentage of the total CPI, we're looking at 76% of that 3.4% growth rate is driven by shelter and auto insurance, or that transportation services. To the extent we start to see rental prices and the cost of rent decline over the next 6 to 12 months, which we would expect based on some of the more current alternative data outside of CPI, you would expect perhaps a downward pressure on that component. That's a major driver. Now, talked about credit card debt. The line in the red is the total consumer credit outstanding reached a new record of $1.3 trillion. That doesn't sound good on the surface, but if you take a look at it as a ratio of personal disposable income, that is the blue line, right? Total credit card debt outstanding divided by disposable personal income in the blue line, it's at 6.5%. And relative to history, it's not very high. It's actually lower than pre-COVID levels and well below that more than 9% ratio that we saw during the tech bubble and throughout the 2000s ahead of the financial crisis. Now, finally, Citigroup. Tough day for the bank, but I think well earned in terms of the fee. They paid UK regulators $78 million for a quote unquote fat finger mistake from a trader in May of 2022. It was sort of a mini flash crash in European equities. Let's unpack what this unfortunate mistake, how it unfolded, if you will. The trader meant to enter $58 million sale, and he entered 58 million shares instead, and an order went out for $444 billion. They were able to catch and bring down the order after only $1.4 billion of that trade was executed. When they unwound that trade, Citigroup took a loss of about $40 million on the trade and the additional fee of $78 million. Very costly mistake for not only the trader, but the bank. So for anybody out there doing detailed work, especially with money, take your time, because fat finger mistakes can cost a lot of money, apparently, in the stock market. With that, I want to thank everybody for watching, and I'll see you next time.